The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Squawk Box with Karen Cho, myself, Steve Sedgwick, and these are your headlines. ASML selling off in its worst day since 1998, sparking heavy losses across global chip stocks. This after the Dutch firm cuts its sales outlook in a premature earnings release. LVMH posting its first fall in quarterly sales since the pandemic, missing expectations, with the luxury giant CFO saying the Chinese consumer confidence has slumped to all-time lows.
Adidas hikes its annual outlook for the third time this year, citing strong momentum in its retro brands and an earnings beat in the third quarter. Choppy trade in Chinese equities as authorities schedule yet another public briefing, with the housing ministry set to give an update on the troubled property sector tomorrow.
Very good morning to you. How are you?
Good morning and welcome back.
It's good to be back. Yes, absolutely lovely to be back on about 3 hours sleep. But what I think was fascinating is the news flow from the weekend onwards. And I actually just want to draw our attention to viewers that the correlation between what we heard from the Chinese ministries over the weekend and what we've seen from corporates in the last 24 hours. And for me, it says, do you want to look top down or do you want to look bottom up? Because if you look top down, the Chinese markets are roaring. The Chinese consumer is going to be back. We've solved this crisis. We've solved that crisis. But actually, if you look bottom up, ASML is saying, we got a problem in China, amongst other things. LVMH is saying, we got a problem in China, amongst other things as well. So it's all very well for global equity investors, and especially for those mainland Chinese investors, to get really, really excited about what the government is trying to do to stimulate the economy. But actually, they've kind of bought on credit, these markets. They've bought on credit because they've bought on the expectations and the aspiration that things are going to get solved. Well, actually, the here and now from these corporates is saying, I don't think so, just not yet.
Yeah, bunker mentality. You've had investors trading around one theme in a bunker, and that is around AI. And the reality is that there are other big themes in the market, and if you ignore them, then it's still going to impact your stock. And Nvidia, for instance, a day earlier, trading at record highs around the AI story. And then overnight, it gets infected by ASML. Don't forget the ASML story, in some ways, is a cycle story, but it's also a trade story. The fact that there are trade issues with China, that is impacting the numbers from ASML, but it's also impacting the journey we're seeing in the rest of the semiconductor space, as well as the fact that there are different cycles other than AI impacting semiconductors. So to me, if you're just trading in a bunker around one theme, you're missing the bigger picture. The LVMH story, I mean, we've covered on the weekend these press conference events, but the reality is the Chinese customer, while they've had some good news flow in recent days, are still seeing ghost cities out there. So again, if you're trading in a bunker around the news flow around the Chinese authorities, you're missing the bigger picture. It's going to take a long time to flush out some of the issues in the economy.
I was going to roar in and disagree with you there, but actually I think we're totally agreeing. I think the market loves a thematic. It's always loved a thematic. Ever since I've kind of first entered these markets, nearly 4 decades ago, it's loved the thematic. But quite frankly, you can't just trade on one thing. AI cannot save the world, and we're proving that on a daily basis, as we are with this next story.
Indeed. So ASML has notched its worst trading day since 1998 after a premature earnings release saw its stock plunge more than 15%. The chip equipment maker published results a day early by mistake, reporting net bookings of 2.6 billion euros for the third quarter. That is less than half of what analysts had expected. It also slashed the top end of its guidance range for next year by $5 billion to $35 billion. A look at some of the big Asian chip plays, and across the board you can see in reverse. So pulling back on Tokyo Electron, TSMC, SK Hynix and also Samsung Electronics. So big falls across the board. And to what we're seeing on some of the big European chip stocks too, this is how it is playing out. ASMI in that context down 13% as it also plays catch up to ASML. You can see it is certainly leading the stocks lower in that regard. The rest of the space, BE Semiconductor down double digits, a slight retreat for Infineon. The US chip makers, now I mentioned a day earlier what had transpired thanks to NVIDIA. It was almost the opposite effect, this glow that had really been emitted from one of the big chips in the basket. That was the reverse this time round as the market then recalibrated around ASML. And you could see Advanced Micro trading down more than 5%. Intel, that has suffered its own issues, also sliding, and Qualcomm, one that many like in the basket away from NVIDIA, that stock also retreating more than 2%. Well, speaking of Qualcomm, it is reportedly likely to wait until after the US election to make a decision on whether it wants to pursue an offer to buy Intel Corp. That's according to Bloomberg, which cites people familiar with the matter, and comes a month after the firm made a preliminary approach to Intel. Dr. Ashwath Rao, who is a senior analyst at Counterpoint Research, joins us now. Thank you so much for joining us. Let me just get into what we're seeing. It felt as though investors were so fixated on the AI cycle that they had a wake-up call around some of the other problems in the sector yesterday with ASML. How bad was the outing in your view?
Yeah, hi. Yeah, so basically the Q3 2024 results have been good. It's highest ever quarterly sales at around 7.5 billion. And China remains a key market for ASML, and the substantial portion of the total system sales comes from China. So, however, the net bookings were a bit disappointing. It was around euro 2.6 billion. So, and it's the lowest in the last 4 years. That's primarily because of the slower ramp of the new nodes at the logic customers, basically, and which has changed the litho demand timing, and slightly slow down in capacity additions in memory. However, what we can look for is the memory represents 54% of the order bookings in Q3. That's something and that's doing good. And going forward in Q4 2024 also, the guidance provided is quite good, and it's basically because more and more number of the UE technology is being leveraged to DDR5 and HBM and expansion of DRAM, and that's probably going to drive the revenue growth for ASML in the longer term, basically.
What jumped out in some of the analyst reports around ASML, and this one, thanks to the likes of Citi, is really the concentration of risk around major customers. And Citi points out, look, this is a company that derives a significant share of its revenues from 3 large customers. You could say that about a number of the chip companies in the sector. Is that something that investors should be more aware of now, as we think there are a number of issues from the likes of Intel to Samsung?
Yeah, basically, if you look at the longer term, right, recently they have commissioned the second high-NA tools also. That's going to drive the revenue growth for the later part of the decade. So if we check the adoption of EUV in memory, increasing number of layers, and then leveraging the EUV technology to drive different innovations, basically, is going to help ASML in the longer run. Yeah. So this could be a slight weak caught on order bookings. However, we still believe that the ramp up in foundry, if you look for the ramp up of 2 nanometer technology, then FinFET to GAFET transitions is there, and there are few issues in terms of yield, because of which the orders for the tool makers have been pushed for a quarter or 2 quarters. But however, coming from the second quarter of 2025, definitely both logic and memory is going to drive net revenue sales for ASML.
Look, the key question for me, sir, is when do AI chips become as commoditized as the rest of the global chip market as well? Because when they do, the premium that this sector is trading at is going to dissipate and disappear very, very quickly. How long can NVIDIA keep the moat? How long can AI chips be the one shining star amidst all the clouds as well? Can you answer any of those questions?
Yeah, it's like now for creating these AI chips also, the tool makers are incorporating these chips to enhance the manufacturing processes across different foundries. So without major innovations in tools and such as deposition, etch, or be it lithography, right? The chip makers will struggle with cost efficiency. That's the only problem as of now, and which could slow down the roadmap a bit. But AI adoption is driving higher volume wafer manufacturing. There are more complex designs, die sizes, all will require tremendous amount of cooperation between the tool makers and the chip makers, and they are working together. And it will take a year or two for the entire thing to get on the revenue track, basically, for ASML. Yeah.
Dr. Rao, lovely to get your comments this morning. Thank you very much indeed for kicking off the show with us. Dr. Ashwath Rao, who is Senior Analyst at Counterpoint Research. And that, for me, is the point. Every bit of technology that I've ever seen in history, going back to, I don't know, looms or what have you, or the spinning jenny, if we're talking early industrial revolution, they all become commoditized. They all become industrial commodities eventually. AI chips will be no different. It's just a question of how long before that commoditization happens. And then what kind of level will this market be trading at? And I don't know if we have those answers just yet.
Yeah, I've got to say, it was well over a decade ago that we saw real swings and roundabouts around the chip sector anyway, thanks to what you're talking about. So all the chips that are being used, we saw huge gyrations. So when does AI catch up to that very erratic cycle that you see in the broader chip market is a big question. And take your point, and I was pointing out on the show yesterday, look, there's some competition coming into NVIDIA by mid next year. That is a time frame when you look for some of the competitors to crowd into the space. In terms of what you're seeing today, for me, what jumps out, you had a huge reaction in the share price. Some of the reaction from the broker community is that this is not a clearing event. That was from the likes of Citi. And you think after volunteering this information, taking down some of the guidance as well, that we would be at almost a kitchen sinking type of exercise, but we're not there, which worries me. What more is there around the corner? And I think when it comes to how this cycle has also been upended, it is thanks to some of the trade wars that have been playing out. I mentioned China, but there's more on the horizon apparently around some of the Gulf states, and whether you may see the Middle East also on the target list for receiving some of these chips and what sort of access they can receive. The US is looking at that. So if we cast the net even wider on who is going to be caught up in some of the trade wars around high-end technology, then it has even more of a ramification for the sector as to who they can sell to.
And you know what? Great. Let's see a more measured response to the chip sector, to AI, when results come out, because the extra volatility this is adding to the market is quite frankly not helping a lot of us out there as well. In fact, it's not helping a lot of sectors which actually, for instance in the S&P, which could thrive if they weren't being swayed so aggressively by one sector, albeit with some dominant names in it as well. If we look at the levels of the S&P 500, it is up 22% this year, and still the bulk of that is still coming from those big technology names. But actually, there's no reason why 493 companies should move as aggressively as they do on the back of one thematic. And I say, bring it on.
You know what jumps out to me is that every month now since August, we have had some sort of jolt for the semiconductor index. So in August, it was the market meltdown that saw the Philadelphia Semiconductor Index, for instance, tanking. We recovered. Then there was a September volatility. The market index sold off again, got back. And it was actually just yesterday, I was looking at where the index was starting up the trading. It was like 5,400. Tanked again yesterday thanks to this event, to down about 5+%. So it's telling you about extreme volatility in 3 months just in the semiconductor index alone. Well, for more on ASML's fat finger moment and how the company expects its China business to fare in the face of US export controls, you can check out CNBC.com.
Right, coming up on the show, well, we've already discussed it a little bit, but more China weakness in the luxury sector as LVMH reports third quarter sales. Charlotte, who's already been on Capital Connection Day, will join us after the break with those numbers. Plus, you can't move for seeing Sambas, Bambas, you name it as well. Gazelle, they're everywhere. SL72s. I'm talking about Adidas and their retro sneakers. Sneakers? What's a sneaker? That's a trainer to me. We'll bring you the details after the break. And Leonardo and the Rheinmetall joining forces to create what they say will be a new European nucleus for the production of military combat vehicles. We'll speak to the CEO of Leonardo, Roberto Cingolani. That's later this hour.
We saw markets in retreat yesterday. A brief moment where we had another fresh record on the Dow, but then falling into a reverse, as you can see across the major boards, from 0.75% stripped off the Dow and the S&P 500 to 1% down for the Nasdaq. The markets had a lot to contend with. We had bank earnings, we had concerns around the chip sector thanks to ASML, we had problems in the luxury space. So the market getting a real dose of everything in that session yesterday. Big movers to the downside, clearly though, a big cap space, and that was Nvidia falling to the bottom of the boards for the S&P 500, the big stock that is causing the index to move into reverse. Also same story for the Nasdaq. And don't forget the opposite of a day earlier, where we saw Nvidia rally to an all-time high and was a real catalyst for the markets to the upside towards those records. So it certainly was in retreat. Apple was still positive for the S&P 500, and you can see the trade as a result up to the tune of 1.1%. Want to take it to Treasuries. The market again refocusing on what we've got from the central bank and what is still lying ahead. 96% chance of a 25 basis point rate cut from the Fed next month. Don't forget those assumptions changing in the last number of weeks away from another jumbo size rate reduction. The 2-year perched to 3.95, so just pushing again back off that 4% handle. The 10-year also sliding, 4.03 is where we are trading. To the Asian markets. Now, this chip story has fallen far and wide across the Asian region, impacting a lot of those big chip stocks. And what we've got across that market as a result, impact on Japanese stocks down close to 2%. So the region being hit. The Kospi, a lot of chip names also located down 0.8%. When it comes to the Chinese markets, the bellwether around luxury, LVMH, and the warnings we've seen now around some of those shopping habits is, again, another negative on the health of the consumer and the Chinese economy. That said, we've got another press conference scheduled for this week around the property market on Thursday. So some hope still alive around the trickle of news flow we continue to hear, suggesting that the Chinese authorities are serious about improving the state of play domestically. So we're up on the Hong Kong and Chinese markets. To the opening calls, and what we're witnessing here is that the European markets are set to slide. We were down yesterday by about 0.8% on the benchmark. The market's expected to give back more territory today, Steve.
I've got a link here, but I'm going to change it. The words even Karen Cho have just come to my mind because a little conversation, and again, this is very indiscreet of me, because a little conversation was going on off air between Charlotte, who's joined us, hello, hi, and Karen, who was already with us, hello again, and even Karen Cho has come, it should be a metaphor. Even Karen Cho thinks LVMH has got expensive, thinks Louis Vuitton has got, and I've thought it was expensive 32 years ago. But the luxury giant, the sales declining 3% in the third quarter. They missed estimates. The group's warning of an uncertain outlook, wider pullback in spending China. But more important than China falling back, even this is what the market should be worried about. Even Karen Cho thinks it's got expensive.
Well, I think everything's expensive, but for me, the bellwether...
yeah, that's not what you said.
But the bellwether LVMH is the one that's been setting the scene for the industry. It keeps on pricing up, and others are trying to price up behind it. Yeah. So if it changes tact, then that is
Gucci
perhaps a catalyst for the market. Exactly. So it has actually tried to keep pace with Louis Vuitton. So the fact, if it changes strategy, you get some impact for luxury. But Charlotte's saying that's not the tone they're taking just yet.
No, they were asked about this yesterday. The CFO asked, are you going to put some cheaper prices to attract, to build a bridge to the aspirational buyer? Because a lot of them have been squeezed out the past few quarters, and they said that would be a mistake. So no change of strategy at LVMH there. So you see that could be impacting the sales in the US and in Europe, where the sales were lower this quarter than in the previous quarter. But of course, when you add this to what's happening in China, we know a big engine for luxury before the pandemic, and they have really been struggling to recover. You have the boom just after the pandemic, but now things have been slowing down quite dramatically. Sales in Asia, excluding Japan, down 16% in the third quarter against 14% in the second quarter. So things are actually getting worse there. So they see that the stimulus measures in China shows that the authorities there are taking the issue seriously, but they say at the moment, in terms of outlook, they don't give outlook at LVMH, but they said the Golden Week didn't seem to show any change in trend in China there. So again, they're cautiously optimistic for the US, and for Europe, they see spending from Chinese customers in Europe and the US slightly improving, but certainly in Asia, things are not improving. Looking at different divisions, fashion and leather, which again makes the bulk of the profit for LVMH with their brands Vuitton and Dior. It was a worst quarterly performance. Did the second quarter of 2020. Remember, that's when all the lockdowns were being put into place across the world. So Wine and spirits, their organic revenue down 7%. They say that's a division that is more affected by the macro environment than others. And they said the news on cognac, because remember the Chinese authority announcing new tariffs on European brandy, most of it being cognac, said this is additional bad news in a division that's already being, in a market that's already being weakened. Watches and jewelry down 4%. They said they continue to renovate their Tiffany stores, so they're still working on improving the image of the brand. And they've restored about 25% of their shops, and they continue on that front. And finally, selective retailing, Sephora still shining, still doing very well, but it's a smaller division for them. So here again, very interesting to see how, as you were saying, normally Louis Vuitton, we've seen other brands suffering swings, going in and out of fashion more. Vuitton has been one that's been more of a stable one, the staple, the one you go to, the one that doesn't seem to be too impacted. The fact that it is impacted, CNBC saying it could indicate that the slowdown is more pronounced than expected when it comes to luxury, when even Vuitton is impacted.
Let me ask you both a question, because it's something I've explored myself personally, and obviously we've talked about on this channel many times over years. Yes, I appreciate that it is the high end of luxury spending because people like treating themselves and buying luxury goods. But is the top end of the cognac market, is the top end of the leather goods market, is it still at all a store of value? Because some people say, a Birkin bag, hang on to it, it will get value. The top end of the watch market, the top end of the wine market. I've looked at this, I've had a look at it personally, I've had a look at it professionally, and I see incredible weakness on automobiles, on art, on wine and watches, which are four of those key alternative investments you'll get at the weekend on CNBC every now and again as well. So is that end of the market actually still a store of value? And I would argue potentially it's not.
I'm with you, I've got to say. There's so much volume out there. It's a supply and demand story again. And there's been a lot of purchasing, as we know, from the high-end customer, which means there is a lot of store of value out there. I think if you're buying very select handbags where there's one or two of them, there's a huge wait list, same thing around timepieces, jewelry, then perhaps. But I would say if you're just buying something off the rack at a sub 10,000, forget about it. It's not a store of value.
That sentence you just said is extraordinary. If you're just buying something that's sub 10,000, forget about it. I'm not saying you're wrong. I just find it's an extraordinary statement that's your benchmark for even getting in the game with a store of value.
But in terms of the shares, we know they've been trading much lower recently. And it's interesting to hear from Luca Solca for Bernstein say, look, he shares the confidence, like the company, that the demand will eventually come back, and say, maybe it is actually the moment to buy those shares where they are lower. We see some price target being cut this morning, JP Morgan and RBC. But interesting to hear from Bernstein say, look, maybe actually it is the time because you're going to have low interest rates in the US and in Europe, the stimulus potentially coming into play in China. So could this be as bad as it gets? Could there be some recovery? Again, we don't know. This quarter was worse than expected, so the bad news could continue. But there are potentially some tailwinds.
Forward. That's still a premium to the lows that we've seen of the last few years. I've seen them, don't get me wrong, I've seen them a lot higher. I've seen them 25, 27 times, but I have seen them down to 18, 19 as well.
To be fair, volatility, I just said something about ships before the break, which is that you had an event in August, one in September, and one again in October that's roiled the chip market. You've had the same thing in luxury. We had the same market sell-off in August and September, upending luxury, and now this other event that is taking place around one stock in particular that has now upended the October trade. So for 3 months in a row, incredibly volatile trade in these names.
Let's do you want to do Ferragamo as well? Great. We'll see you later, yeah? You joining us for the analyst?
Sure.
I don't know if I've just broken the rules with the producers.
Me, I'll be here.
Well, let's talk about the rest of the space. Italian luxury group Ferragamo says full-year profit will be at the bottom end of analyst estimates. This after revenue slumped 7.2% in the third quarter. The company says it's seen weaker consumer confidence, particularly in the Asia-Pacific, where net sales fell more than 20%.
I love a bit of Adidas, yeah.
You do?
I've also been spending money at the other place over the weekend as well. A lot.
The one starting with N?
Yeah.
Adidas has raised its guidance for the third time this year after better than expected performance in the third quarter. Boosted by its retro sneakers, the sportswear maker now sees sales growing 10% this year, while profits expected to hit 1.2 billion euros. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.